Hello again, everybody. My name is Jeremy Wagner of Daily FX Education, and I want to welcome you here to FX Street. I want to welcome you to this webinar where it's a fourth part of our limit order series, where basically we're going out, we're talking about different order types, how to incorporate those order types into a current strategy. And so the strategy that we're talking about today is going to be Elliott Wave and Fibonacci, and tying those two things together. Believe it or not, there is a significant relationship between the two. You can trade Fibonacci without using Elliott Wave. You could probably trade some of the Elliott Wave without Fibonacci, but if you are interested in trading Elliott Wave, Fibonacci is going to be a very good and very close friend of yours. And so here are the things that I'm going to be mentioning in today's webinar. So if you have any questions about any of these things that you see on your screen at this time, simply type those into the chat box and we'll go through and answer those questions as this webinar moves along. Additionally, if you are familiar with Elliott Wave and if you see a trading opportunity or if you see a very nice Elliott Wave formation out there that could lead to a trading opportunity, point that out in the chat box and then we'll take a look at it here in real time. Also, I'm going to be sharing with you not only the Fibonacci sequence and some of the common Fibonacci ratios, but I'm going to share with you my favorite Fibonacci retracement level. So once we get to that point, if you see any trading opportunities that are developing by virtue of my favorite Fibonacci retracement level, then we'll go ahead and we'll take a look at those in real time as well. So you can type those into the chat box. And then we're going to finish up here with the Elliott Wave theory. There's 3 cardinal rules that we're going to discuss with regards to Elliott Wave theory, and then the 4 guidelines, which is where the fib levels come into play. And so I think what you're going to find out, or at least what I found out over the years, is that Elliott Wave, in my opinion, is a controversial type of topic. A lot of traders are attracted towards Elliott Wave because it has a very rigid set of rules. I'm going to be going over 3 cardinal rules. These rules exist. They are not to be broken. And so a lot of traders are attracted to Elliott Wave because of that. However, we're traders. And so using Elliott Wave to find trades is actually fairly difficult. This is more of an advanced topic. So going out and counting waves is simple. It's easy. But using and anticipating those wave counts to identify trading opportunities is what can be challenging. And I'm going to pinpoint 2 of the waves that I like to focus in on and try to develop some trading opportunities from. So let's start off here with the order types. We're going to get into the market, the stop, the limit orders. This will just take a couple of minutes, and then we'll tie in how this fits into the Elliott Wave and Fibonacci. So as you may know, market orders are orders that you want to get into the market at right now. So you want to be executed. You might get the requested price of when you clicked on that trading station to get entered into that trade. You could receive a better price, which is known as positive slippage. You could receive a worse price, which is known as negative slippage. Those are the risks associated with placing market orders. Now, stop orders are orders that are placed at a price level less favorable than the current market price. So if you are looking to go long the euro dollar, which by the way has had a nice run up here today, if you're looking to go long the euro dollar, a stop order would be getting in at a less favorable price. If you want to buy, what's a less favorable price? Well, higher is less favorable. That becomes a market order. When it is triggered, it's possible that you could get that requested price. It's possible you could receive a worse price and negative slippage. Now, the limit order is where you want to get entered into a trade at a more favorable level than the current market price. So again, if I want to go long the euro dollar, and if I want to get in at a better price to buy is going to be at a lower price. So that could be a limit entry order. That could be a limit take profit order. And the great thing about limit orders is that you get executed at your requested price, or you have the potential to receive positive slippage as well and a better price. So that's the point behind the limit order series, is that we, as a trader, we want to be able to set ourselves up so that we have the opportunity and some type of edge to potentially profit from. And so by placing a limit take profit order, for example, if you're a scalper or a day trader, you like to go out and knock off a couple of pips a day, place a limit take profit order on each of your trades, because if the market gets volatile and happens to gap through several price points, well, you could actually get the benefit from price improvements on your trade by using that limit take profit order. That becomes very important if you're a day trader or a scalper where you're only looking for a couple of pips. 1 pip on a 10 pip take profit level is 10% improvement of your whole trade. All right, so let's get into some of the basics here. I know we've got folks coming in from all walks of life, and Fibonacci is a very popular tool out there. And so this was something that was discovered back in the 13th century. So the Fibonacci sequence has been around for a very long time, and a lot of people see Fibonacci. It shows up in nature, it shows up inside our bodies as far as the ratio. What is that ratio? What is exactly did Fibonacci do? And what he did is he discovered this number sequence, where basically you start off with 0, and then 1, and then you add the previous two numbers. So 0 plus 1 is 1. 1 plus 1 is 2, so on and so forth. And this number sequence moves on forever. Now, the interesting thing about the Fibonacci sequence is that if you divide two of the numbers together, so for example, if I take 8 divided by 13, the farther you move out, this number progresses towards 0.618, and that's considered the golden ratio. That is the number that is found out in nature, the ratio between various parts of our body and bone lengths and things along those lines. And so that's the essence, that's the basis behind the Fibonacci retracement levels, this 618. And so like in this example, if you take 21 divided by 34, it's not going to be exactly 618, but it's going to be fairly close. Now, where does the 382 come from? That's also a very popular number that shows up on the Fibonacci retracement levels in the charting packages. Where does that come from? Well, that's where you take a number, you divide it into the number 2 positions towards the right. So in this case, if you take 21 divided by 55, so you take 21 divided by 2 positions to the right, 55, that number's 382, or it progresses towards 382. So now we've got 2 of the main numbers that are involved in our Fibonacci retracement levels. And the third one that's very common is the 50% retracement level. And that really has nothing to do with Fibonacci. That was just simply thrown out there in addition to the 618 and the 382. Now I want to share with you my personal favorite. Now this is a number that is not native to a lot of charting packages, but I have my chart set up so that this number, this Fibonacci, this retracement level rather, shows up every time I draw my Fibonacci levels out there. It's the 786. So I've got a question for you guys. I want you to type into the chat box here. This is a bonus question. Really has nothing to do with trading. It's just a fun, one of those types of questions that you program in next to, you know, who won the gymnastics in the 1992 Olympics. I mean, it really doesn't mean anything in life, how it's derived, but I'm just kind of curious if anybody knows. What is the relationship between 618 and 786? The 786 is a derivation of the 618. Does anybody in the room know how the 786 level has come about? Yeah, exactly, Greg. You're exactly right. You take the square root of 618, and that's where you get 786. Now, the 786 level is my favorite because it is considered by traders as the retracement of last resort. And so, what do I mean by that? Well, a 61% retracement level is fairly deep. A lot of traders use that. I agree. That's a very good level to look for retracements and enter into. The 786 is an even deeper level. And so if you're in an uptrend and prices are retracing downward and they retrace deep enough to that 78% retracement level, then either it finds support at that level or it blows on through and creates a new low. So it's the type of trade that I like to see because you get a confirmation on your trade one way or the other, good or bad. You get a confirmation on your trade in fairly short order, and the potential and the 786 trade, in my opinion, offers you a good chance at a good risk reward ratio. A lot of times I can get a 1-to-3 risk reward ratio. So I'm going to go over more on how to use that in a moment. Let's move into Elliott Wave theory. And if you guys could go ahead and type into the chat box here, I just want to get a lay of the land here. How many of you guys are familiar with Elliott Wave? So a couple of different categories. You use Elliott Wave all the time. You know of it. You can, if somebody describes it to you, you could probably interpret it. Or the third category would be you have absolutely no idea what it is. This is the first time that you've heard of it. So let me know, where you're at in that scale. Is that something that you're familiar with? You use it all the time, or you have no idea? Yeah, Boyke back burner. Don't know how to use it. Yeah. Thank you very much. And so it's something, like I said earlier on, that it is controversial in that it has a very rigid set of rules. That's what makes it very attractive. And I will admit to you, the challenge with Elliott Wave is identifying trading opportunities in the market. And so what we're going to find out here in a moment is that we don't necessarily have to know how to use Elliott Wave. We're going to use the Fibonacci retracement levels as our crutch and then just piece a puzzle together with the limited information that Elliott Wave is providing us and the limited information that Fibonacci is providing to us as well. So Nathan, you're absolutely right. It's pretty difficult to interpret the waves. The rules are the rules. You can easily see them after a trade has developed, but that doesn't do you any good in the moment, because in the moment you're looking for a trading opportunity now. So Elliott Wave was developed by Ralph Nelson Elliott. A lot of times you'll hear him referred to as R.N. Elliott, and even here around our office we call him the nurse, R.N. Elliott. So, and that's because here in the United States, R.N. registered nurse, little bit of a joke. So anyway, he did this back in the 1930s. Now what's interesting, if you think about this, in the 1930s, there were not computers. And so here was a guy who developed this trading strategy on a piece of paper and with a pencil and oftentimes with delayed information. So think about this for a minute, that when you're out there and you're developing a strategy or you're working on a strategy, you've got a lot of tools, you've got a lot of computer, you've got a lot of firepower behind you to help you out. And so he developed this without all of these tools. And so think how frustrated we get when we're developing a strategy. And this guy sought it through. So, and this has stood the test of time as well as Fibonacci. Fibonacci's been around for hundreds of years. Elliott Wave theory has been around for almost a decade now as well. So, it stood the test of time. What he found out is that market moves in waves. 5 waves move in the direction of the trend. 3 waves move against that direction, that trend. Now, one thing must be noted here is that trend is a function of the time frame that you're looking at. So I could be looking at a 5-minute chart, and I could discern based on the Elliott Wave theory that the trend is up. You could be looking at a daily chart, and based on Elliott Wave theory, you could say that the trend is down. And they both could be correct because it depends on the degree of trend. It depends on the time frame of chart that we're looking at. So my question here for you guys, do you notice anything about the number of waves above? Do you see anything significant about the number 5 and the number 3? Go ahead and type that into the chat box. Yeah, they're numbers in the Fibonacci sequence. So it only makes sense, and yeah, if you add 5 and 3 together, you get the number 8. And so each of those numbers, 3, 5, and 8, are Fibonacci numbers. And so it would make sense that Fibonacci and Elliott Wave are married together. So here's an idealized Fibonacci, or rather Elliott Wave sequence, 5 waves in the direction of the trend, 1, 2, 3, 4, 5, 3 waves against the trend to the downside. And so this is going to be the basis of how we're going to identify trading opportunities. Now, by the way, we've got 8 potential waves here in this sequence. The 2 waves that I'm going to focus in on trading opportunities is going to be wave 3. It's going to be this guy right here. And then wave 5, this guy right here. So here are the cardinal rules. Wave 2 never retraces more than 100% of wave 1. So let me back up here. Notice wave 2, it never fully retraces. It's only a partial retracement of wave 1. And so like here, this red 3-wave countertrend move, this is going to be a partial retracement of this whole blue move. Another rule, wave 3 is never the shortest of 1, 3, and 5. So you notice here, notice how 3 is oftentimes the longest. And even in currencies, wave 5 tends to be the longest as well. You tend to get an extension in wave 5 in currencies. So if you get frustrated by using Elliott Wave, think about where you're at in the sequence. And if you're trying to anticipate the end of wave 5, well, a lot of times in currencies, wave 5 will extend. That means it will continue to progress farther. So wave 3 is definitely not the shortest. A lot of times it is the longest. Wave 4 does not enter the territory of wave 1. So you can see here on the wave 4 retracement, it did not reach or impede inside the high of wave 1. And so those are the 3 cardinal rules. Notice the language used on these rules. We got never. Wave 2 never retraces. Wave 3 is never the shortest. Wave 4 never enters the territory of wave 1. Yes, they are hard and fast. And so what happens if we're looking at a chart and these rules are violated? What happens? What does that mean? Well, those rules are the rules. So that means that there's another way to label that chart. And that's where a lot of traders get tripped up on. So what are some of the guidelines? There are a couple of guidelines that we're going to use here. And this is where Fibonacci is going to come into play. Wave 2 typically retraces 50 to 78% of wave 1. Let me go back here. So wave 2 typically retraces 50 to 78% of wave 1. And so if we anticipate the end of wave 2, if we can time the end of wave 2, then we are anticipating the start of wave 3, which is one of the waves that I want to be able to trade. And sometimes it is the longest. Another guideline that we're going to use, and these are guidelines, they're not always going to be right, but a lot of times you'll find that it fits in the wave structure. So these are clues that are provided to us that the market is giving. Wave 4 typically retraces 38.2% of wave 3. So this wave 4 here, so if you draw a Fibonacci retracement level from the start of wave 3, from this point to the high of wave 3, to the end of wave 3, 38% retracement of that is a lot of times where wave 4 will end. And then if we can time where wave 4 is going to end, then we are anticipating the beginning of wave 5. And remember, wave 5 in currencies sometimes can be the strongest. There tends to be a lot of extensions in wave 5. So these are, in my opinion, 2 of the most juiciest waves out of this 8-wave sequence. So who cares about wave 1? Who cares about picking a top and bottom? Who cares about wave 4 in the essence of trading it, or the wave A, or the B, or the C of the counter trend move? We want to get the fat part of the bat on the ball here. We want to get the wave 3. We want to get the wave 5, in my opinion. Now, Boyke, how do we know where to start? That's a great question. And hopefully I'll share some charts with you here in a moment. Not hopefully, I will share some charts with you here in a moment. And we'll talk about that some more. That's where Elliott Wave trading does get difficult. But if you have a familiarity with using fibs, and if you just hang your hat on the 78% retracement level, then it's not so much the importance of how the waves are labeled. We're just looking for, again, a juicy part of a wave to trade. So here's the action points. Here's the takeaways. And that, how does all this tie into the limit orders? And we want to increase the potential for positive slippage. And so that means that we want to look for strategies that incorporate our limit or take profit orders or limit entry orders. And we can do that with Elliott Wave. We can do that by anticipating the wave 3 or the wave 5. So let's head out to the charts here. Just a minute. Let me change my camera? All right, so you should be able to see my chart right now. This is a euro-dollar daily chart. Are you guys able to see this okay? And Boyke, I see what you're saying there. What time frame is the best to use? The markets are fractal, and so you can apply this strategy. You can apply most any strategy to any time frame of the chart. But you got to think about what is it that the various time frames of the chart give you. There's always some type of give and take in trading. If I scroll in to a smaller time frame chart, if I scroll into, let's say, a 5-minute chart, what that means is I'm going to get more trading opportunities. I'm going to see more trade setups. I'm going to get more signals. The downside of using a smaller time frame chart is there's just not as much trading volume included in that 5-minute candle or that 5-minute bar relative to what you would find if you were using a daily chart, for example. Therefore, you may get more signals on a 5-minute chart, but the signals you tend to have more false signals. And then the flip side of that, use a daily chart, use a weekly chart. A lot of times, the signals you get, whether you're using Elliott Wave, whether you're using support and resistance, breakouts, the signals you get tend to be stronger on a daily or on a weekly chart. However, you just don't get as many signals. You could be sitting around for a year waiting for a signal on a daily or weekly chart. All right, so here we're taking a look at the euro-dollar daily chart. And so I've got this labeled as a 1 to the downside, a 2 to the upside. So I do think that we are entrenched, in my opinion, on a euro-dollar downtrend. And if this is labeled correctly, which, again, we're not going to know if this is labeled correctly until the whole sequence has played out. And so by then, that means the whole price movement's going to be over. So we don't know in the heat of the battle. We don't know if this is correct. We only know if it's correct depending on how the market plays out. But we're just using some of the rules in order to help identify opportunities. So let me just share with you how some of this shakes out. So this was a 5-wave move to the downside. Here's our 3-wave, A, B, C, move back to the upside. And let's just draw some fibs out here. And let's just test and see what happened on this euro-dollar downtrend. So I draw my fibs from the high to the low. And my Fibonacci's, by the way, I have them defaulted to the 61.8 and to the 7.86. These are the fibs that I care about the most. And then a little bit on the 3.82. And so you can see it. We blew through the 618. We came very close to the 786. And so that guideline, one of the guidelines that I mentioned, fits into this mold. So if this is correct, that means we are working on a wave 3 to the downside, a big Roman numeral 3 to the downside. And if this is true, then you're looking at whatever this distance was from 160 to 123, so that's going to be about 3,700 pips. Minimally, the distance from here is going to be that same level, 3,700 pips. A lot of times, it can be a 1.618 of that level. So if this is correct, this could be a 5,000 to 6,000 pip move from this point. And what does that mean? At the 150 level, a 5,000 to 6,000 pip move means that according to the way this is labeled, which again, we don't know if this is correct, the euro dollar is going to hit parity and possibly even blow below it. Will that happen tomorrow? Will that happen next week? No. Could it happen this year? Doubtful. But over the course of time, you're more likely, in my opinion, based on Elliott Wave, to see parity than you are the 150 level. And since we are closer to the 150 level, this helps generate an opportunity for us. Now let's focus in on this wave right here, because this may be a smaller degree of trend. Another smaller, there's a 5-wave move to the downside, and we're working on a 3-wave counter trend move to the upside. So let me get rid of this retracement level right here. Let's zoom in on this structure. So if this is a smaller degree 1 down and a possible wave 2 up, I'm just simply going to draw my fibs and see where this might terminate at. Now this came very close to the 786. I thought that was the high, but based on this action, going on right here, I'm holding out for prices to push back into the 140 level, possibly even up above into the 786 level. So I'm going to be an observer on the euro dollar. I'm going to wait for higher levels to ensue and then break out the gunpowder and start looking for some short trades on it. So where exactly am I setting the sights on this target? One place that I'm setting my sights, this is a little trick that I use on corrective waves, because this is a counter trend corrective wave, is I will use equal wavelengths. So what I'm doing is I'm drawing a line to essentially measure from this low point to this high point of that wave, and then I'm just simply going to apply it to the beginning of this wave that we're on right now. Look what happens, guys. The length of this wave right here would be equal right at the 786 retracement level. So the euro dollar could be volatile. It could be bouncing up and down here over the next several days, several weeks, maybe even several months. But I'm going to keep this in perspective. I'm going to look for prices to push above the 140 level. And if it does push above the 142 level, like I think it will, I'm going to start getting really excited about the 144 level as a place to go short. All right, so that's the euro dollar. And Nathan, is it a proven fact that Elliott waves work the same like Fibonacci? And again, it all boils down to interpretation. The rules of Fibonacci, the rules of Elliott wave, are not to be broken. However, if I'm labeling a chart and it breaks one of the rules, what does that mean? That means I've labeled the chart incorrectly. So it's not that Elliott wave was incorrect, it's that my application of it was incorrect. And that's the difficult thing with trading Elliott waves, is there are people that will study this for years and even decades to only become an expert after that. And that is an excellent question, Fernando. I'm glad that you asked that. So using Elliott is what Fernando's saying. While the price action is going on, you need to assume where you are, and only after the fact may you be proven wrong. To some degree, yes, what you said there is true. Only when our trade gets stopped out will we be proven wrong. So how can you trade this 1-2 punch? Okay, regardless of whether this is a daily chart or whether this is an hourly chart. Let's say you saw a similar pattern. You saw a strong move down, a deep retracement to the 78% retracement level. This is how I use my favorite retracement level, 78%. I look to enter short at the 78% retracement level, place my stop just above the high. Again, whether it's a daily chart, whether it's a 5-minute chart, whether it's an hourly chart, that's what I look to do. And what does that afford to me? That means here is my stop distance. Okay, don't worry about what the distance is in pips. Look at the relative size here. And let me make this red. Okay, here's my stop distance. And if this is correct, here is what my profit potential is. So if you're looking at a trading opportunity, would you like to have this risk to reward potential? And to me, the answer to that question is yes. I would like to have these types of risk-reward potentials. This risk on a relative basis is relatively small to the potential reward. All right, so let's dial down to some smaller time frame charts, and let's see how we could apply this. Let me change my chart here. Actually, let's look at the dollar-yen. Let's look at a 4-hour chart. Okay. Now, dollar-yen has been entrenched in a downtrend. However, I think we are going to have, based on Elliott wave, I think we're going to have a strong up move coming here on the dollar-yen. So let's use Elliott wave, let's use Fibonacci to help us identify some strong areas on the charts where we have a good possibility at a good risk-reward ratio. Again, I'm not necessarily trying to predict what's going to happen. I'm just using these patterns to help identify high probability trading zones, and so that way, even if I'm right, or even if my wave labeling is wrong, I still want to give myself a potential to win out on the trade. So this could be right here a similar nesting as to what we were seeing inside the euro dollar. So this could be a Roman numeral I, letter 1 on the way up. This could be number 2. So it's nesting, it's building. And why is that the case? Because wave 2 never retraced the complete distance of wave 1. And then notice how an impulsive wave, the 5-wave move, a lot of times they tend to be very sharp. They tend to be very strong. And so notice how this is a very strong projection to the upside. Look at this correction. Look how it just kind of drifts. It just kind of meanders back to the downside. And then boom, we've got a strong projection to the upside. And then it's starting to drift and meander back to the downside. So these are clues that we can take from the market that, you know what, I don't know if this wave labeling is correct, but let's use these clues and see if we can identify a zone to enter into a trade. And so we are building on higher highs and higher lows now on the Elliott, just by general trend direction. So here's a smaller 1, 2, 3, 4, 5. And does anybody want to type into the chart, based on this sequence, where do you think a high probability entry zone would be in going long? So let's just start off with that entry price. Where's that entry area where we would look for some type of trade going long? Yeah, you could look for an ABC correction. That's correct. At the end of wave C. And Fernando, 61.8 or 78.6 of 1 to 5. Exactly. So I'm going to draw my Fibonacci levels from the beginning of this whole wave sequence, 1, 2, 3, 4, 5, to the end of this wave sequence. And so here's what the result is. So we got the 61% retracement level at 82.20. We got the 78% retracement level at 81.70. So this becomes our initial box of where we're going to be looking for some type of retracement into. Let me go ahead and just draw a green box here. All right, so here's the beginning of our zone. And, you know, we're not too far away from it right now. We're about 20 pips or so. All right, next question for you. Where, if I enter into this long trade inside this green box, where am I going to place a stop? So type that into the chat box. Where would I place my stop in a long trade if I enter in to a long trade inside this green box? And Fernando, that's a good one. Below wave 2, around the 78.6 or around 81. Yeah, Ham is exactly correct. I'm going to want to place a stop just below the low right here. So the beginning of this whole move, because again, remember the rules. The rules are wave 2 or this down move never retraces the full distance of wave 1. So if I'm anticipating this is my wave labeling, I want to place my stop just below the beginning here, because if prices come into the green box and if prices become a runaway train to the downside and it ends up blowing through the 81 level, I want taken out of the trade. I no longer want to be in this trade because the way I've labeled this chart is incorrect. And that's okay. It happens quite frequently. I'm not going to be right all the time. However, where is my take profit level going to be on this? So if I'm placing a stop down below this level, where am I going to look to enter a limit order to take profit on this trade? So go ahead and type that into the chat box as well. Any guesses? All right, let me give you a clue. Okay, when you see corrective moves, corrective moves tend to be fully retraced. So if this is correct, if I've labeled this correct, then that means prices are going to blow above this 84 level. Now, I could take profits at the 84 level. I could look for a higher projection on this based on the 161.8 extension, like Patrick mentions. There's a lot of different places I could take profit, but check this out. This is why I'm going to illustrate to you why I like the 78% retracement level. I would look for an entry just in this lower zone. Actually, anywhere in this green box I think is going to be pretty good because, number one, look, I've got a low here right on the 61% retracement level. Look also down here by the 786. I've also got this candle protruding down here. So it's very possible that these areas, these two candles, may provide support. So those two bottom of those candles are going to be good entry zones. Now let's say I'm going to be patient and I'm going to wait for it to come down here to the 786. So I'm going to enter very near this line. This is going to be my stop. It's going to be down here. If prices move down in this level, here's my stop distance. Check this out. So if I enter near the 786, near this blue line, there's my profit potential. Okay? Now, if I want to use a more conservative, this is probably a 1 to 3 risk to reward ratio. If I want to be more conservative, maybe I make it a 1 to 2 risk to reward ratio. Maybe I do something like this, just below the high of this candle. Okay, so this is why I love the 78% retracement level, because it gives me a good chance at a good risk to reward ratio. Within the context of this whole entire range, I can get a 1 to 2 risk to reward ratio. I can get a 1 to 3. Or if my wave labeling, and that has nothing to do with the wave labeling, and if my wave labeling is correct, then the dollar yen could even project even higher up into the higher 88s. And so, my risk reward ratio could be 1 to 7 or 1 to 10. I mean, this is why I like it. And so, a lot of times what I'll do is I will trail my stop, give the trade room to breathe, and I will trail my stop, because if this is wave labeling is correct, this move to the upside has the potential to be powerful. All right. So one of the questions I saw earlier was, how do you know where to draw? How do you know where to begin? What are some clues that I take out of the market to help me begin to ascertain how to possibly label this? And Fernando, you're absolutely correct. Could you do this without any regard to Elliott Wave? You sure could. You could just look for 78% retracement levels. But I think the edge that Elliott Wave is going to bring to you, Fernando, is that if you can pattern out 5-wave moves, and if you can pattern out 3-wave counter trend moves, that would give you more credence. That would make me feel better that this 78% level is more likely to hold. If I don't see these 5-wave patterns and the 3-wave counter trend move, sure, you could try to enter in at the 78% retracement level, but you may increase your risk of prices moving on down below this low and getting stopped out of the trade. So the Elliott Wave is that extra thing that helps give me an edge on this particular trading pattern. So how do we know where to begin? In this case, let me pull up the Kiwi dollar. One of the things that I look for is a couple of things, actually. Triangles. If you guys see any triangles, just, any type of triangle pattern out in the market, type that into the chat box. We'll check it out. Triangles is one method where I use to help anticipate a wave 5 or a thrust outside that triangle. So triangle is one thing. Another thing that I look for is I look for sharp moves. So with the earthquake, the unfortunate earthquake that occurred in New Zealand earlier this week, well, that created a very sharp move on the New Zealand dollar. So let's check out the New Zealand US dollar on a 4-hour chart, and let's just see if this sharp move can tell us anything about where we are sitting in a wave count. And so here we've got the 4-hour chart. And do you guys see anything going on this down move? We got a very sharp correction here over the last couple of days. You see anything about this whole move from the top side? Do you see the essence of a 5-wave move to the downside? Greg says, I can't see the right side of your chart. Okay, all right, does that help? Does that make it better? It's possible we may have a 5-wave move here. And we're actually getting near the end of the 5-wave move. But like I said, in currencies, this 5th wave, a lot of times, can become extended. Meaning, this might be the end of it. There could be more downside pressure coming up ahead. But you see how we're developing a 5-wave move. Let's check out the rules that I talked about, the cardinal rules. Wave 2 never retraces. It's only a partial retracement of the down move. And it is. It's only a partial retracement. Wave 3 is never the shortest. Okay? A lot of times it's the longest. Well, wave 3 here is definitely longer than wave 1. So it fits that portion of the rule. Wave 4 does not enter the price territory of wave 1. So let me draw a horizontal line at the bottom of wave 1. Let's make this a green line. Okay, this green line is the bottom of wave 1. Notice how wave 4 did not push into this territory of wave 1, which, by the way, setting Elliott Wave off to the side in Fibonacci, support and resistance 101. Have you ever heard the adage, what was support? Once it becomes broken, becomes new resistance? Well, look what we've got here. A lot of these things fit together. So the third part of that rule, wave 4 does not enter the price territory of wave 1, fits this mold as well. All right, so what is our trading opportunity here? How do we develop a trade? Let me back up here. Let me look at some of the guidelines that we talked about as well. So let me draw, just so we can see this in action after the fact. Okay, so I'm gonna see how wave 2 tends to retrace 50 to 78%, and it does. It almost made it to the 78% retracement level. And in this case, it's at 77.90. Let me remove this so we can see these candles. Notice how that level coincides with the bottom side of these candles here too. So I may not have looked for a trade right at that level, but maybe a few pips below it. But it's the spirit of that 78% retracement level that I'm looking for. So that was our 1 down, 2 up. Wave 4 tends to terminate near the 38% retracement level of wave 3. So let's just draw from the beginning of wave 3 to the end. Let me change around my fibs so I'm sharing with you the 38% retracement level. So that's around 76.13. And, prices did push a little bit higher. But in this case, what you would do is you would place a stop just above the highs up here. You place a stop on going short. If you had anticipated this wave 5 move, place a stop just above the green line. All right, you know what? Let's look at this pattern right here. Let me look at this area right here, okay? Let me dial this into a smaller time frame chart. Let's try an hourly chart. Okay, here's the hourly chart. Guys, see this pink area? Here's the hourly chart. Do you notice anything about this? Do you see a 5-wave move here? It could have been that this was I2. It did not fully make it up into a new high. It was a partial retracement. Here was 3. And there's 4. And then here was 5, which ended this whole sequence. And then we got our 3-wave countertrend move back to the upside. 3-wave countertrend move, may have been like an A, B, C. The countertrend moves of 3 waves, they get very messy. They're very difficult to pattern out. And so that's why I just simply use the Fibonacci retracement level to look where they terminate. So strong moves can help give me a clue into the market. So let me finish it up here on the Kiwi dollar here. Strong moves can give me a clue that we may be in an impulsive move. We may be a part of that 5-wave sequence like what you saw here. Notice how on the moves to the downside are very sharp. Relatively speaking, the moves to the upside are softer. It takes more time. The move to the downside, very sharp. Upside took a while, and it was only a partial retracement, and then boom, earthquake hit, and then we're here to the downside. So we've had no fade of this move. We've had no retracement of this down move, and so one is likely coming. Let me get rid of these lines here. Where do you guys think, if this indeed is the end of wave 5, where would you look to enter into the Kiwi dollar going short if this wave labeling is correct? That's the big assumption. If this wave labeling is correct, where would you look to enter short? The next question I'm going to ask after that is where would you look to place a stop? Where would you look to take profit at? So go ahead and type into the chat box, where would you look to go short in this currency pair? Let me help provide you some visuals. Because right now, prices are extended. The train has left the station. Okay, this is interesting. Here's my 78% retracement level. Here's my 61% retracement level. This is a very, very interesting chart here. Now, again, this all assumes that this is the bottom. If it continues to push farther, we're going to have to, change our fibs. But if this is indeed the bottom on the Kiwi dollar, notice how my green line and my 61% retracement level lines up. We had former, what was support, could become new resistance in the future. So this 61.8 level, again, if this is the end of this down move, could be some significant resistance into the future, 7,600. 78% retracement level, look what we've got here. I got a long wick, former resistance, a lot of sellers overhead. I've got a lot of sellers overhead right here. That's around the 77.40, 77.50 level. So here are two zones where I'm going to be watching and see if prices can push up into these zones. If prices are successful in pushing up here, because it may not. It could just turn tail before it gets there and head south. But if prices are successful, these are areas I'm going to be looking at. As far as placing the stop, 76.50, yeah. Near the high, that would be a good area. We'll like to see, how it behaves. But yeah, you're in the general area. 78.50 is where you're going to place a stop just above the high here. So my high is around 78.25. Look for a stop just a few pips up above this level. Doesn't have to be a lot. Make it 5 or 10 pips, because if it fully retraces this whole move, then my wave labeling is incorrect. And then, you could look to take profits down here at this level. And especially if you see a very strong, or a very clean, rather, 3-wave move that has overlapping waves, then that would definitely signify a corrective move and look to take profits down there towards the bottom. So, all right, well, we are approaching the end of the hour here. You guys were great. And so I want to finish up with a couple of things. I want to talk a moment about triangles. Before I talk about triangles, I do want to offer up some additional resources to you as well. And so you can, if you want access to any future webinars that we do on Elliott Wave, if you want access to any Elliott Wave materials, to an on-demand video suite, anything along those lines, send me an email, instructor@dailyfx.com, and say, hey, I just want access to the videos. I want access to more Elliott Wave webinars that you guys have done on a recorded basis or even on a live basis. Include all that in the email. And then what I can provide to you is I can provide to you some information on Fibonacci. A Fibonacci video, an Elliott Wave video, as well as access to our mentorship area. And that would be temporary access. So send me an email, and I will get that information back out to you. Now, another thing that I look for to help me determine where we're at in the Elliott Wave structure very quickly is I look for triangles. So I don't see anybody posting anything in the chat box about triangles. And let me show you on the dollar yen. Initially, I was thinking this was a triangle, and so I just want to share with you how things were changed. So at first, I thought this was going to be a triangle. This was a couple of weeks ago. All right, so here was the triangle. I was thinking, oh, you're right. Camera's off. Sorry. There we go. Here's the triangle I thought was going on in the dollar yen. Based on this triangle interpretation, that would have meant prices would have pushed down below these lows. Well, guess what? Prices pushed up above these highs. So that means that this triangle interpretation was wrong. And that's okay. You're going to be wrong. But when the clarity is provided on the charts as to what we're possibly looking at, in this case, we had a very clean 5-wave move that made that triangle interpretation incorrect. So that 5-wave move now shifts our focus to the upside. And we look to the 78% retracement level, possibly even the 61% retracement level as our area to enter into. So look for prices to push another 20 pips lower, 82.20 to the 81.70 area. And let's see what happens here on this dollar yen. Now, this has been entrenched in a very, very long downtrend. So the amount of risk capital that I would want to put forth on this trade is I would want to put forth, a small amount, 1-2%. Because you know what? If you're right, and if you do capture this 1 to 3 risk reward ratio, and if you're right, you're winning 3%. If you do some type of trailing stop and move it up, and we're lucky enough to carry this into the higher 88s, you're looking at adding 5, 6, 7%. So you don't have to risk a lot on this trade. And I would suggest not risking a lot because you will be wrong from time to time, and the professional trader is going to look to risk a small amount of their capital on all open trades. I like to look for 1 to 2%. But we do suggest risking no more than 5% on all open trades. So, all right, well, there's my email address. And again, I want to thank you guys for joining me, and I want to thank FX Street and Maud and Vicky for having me come and share this with you guys. And I hope to be back soon in the very near future. Thank you guys very much for joining me. Look forward to receiving your email, and I look forward to working with you guys in the future. But more importantly, I want to wish you guys the best of luck in your trading, and you guys have a great week. We'll talk to you guys soon. Bye now.